everybody. Welcome to our credit spread masterclass. My name is Scrooge Max Bucks. Over the course of this video, we're going to be going over credit spreads, why they work, how they work, approach that I personally like to take, and more specifically, the strategy that I have been using for the past year to be able to realize close to 50% per month gains on my account. Just did this in February and was able to take a $5,000 account up $6,500 in gains. After fees, I doubled the account to $10,000 and it only took me 3 months. A little bit about me. I am not a millionaire trader. I do not have $1 million in verified trading gains. I do not drive a sports car and I do not fly private. I am just like a lot of you. As a matter of fact, my portfolio might not even look as good as some of yours. However, what I have been able to do over the past year or so of trading is find consistent, successful strategies that are working. And in a short amount of time, have been able to do some pretty incredible things. So, although I'm not quite where I want to be yet, I am absolutely on my way to the top, which gives me the confidence to come to you guys today with this system and try to show you what I have learned and give you guys an opportunity to potentially realize the same level of success. Okay, so the first thing you guys got to understand about credit spreads is it's a version of option selling. Okay, so really all we're doing is selling options. All right, so I had this article here. It kind of goes over a few things about option selling. I thought it was kind of good to highlight. It says that the option buyer can make limited losses, but his wins are unlimited. He screwed that up, but that's what he meant to say. You can, as a buyer, your wins are unlimited, but your losses are defined when you get in. Okay. On the other hand, the option seller makes limited profits up to the premium that they got paid, but risk unlimited losses. Okay, so that's the difference, and that's why it's so important that you guys, watch the plays and have stop losses and market close and all the things that we're going to go over here. All right. It also says who earns more in the long run? Well, the seller of option profits more frequently, which is why I tell you guys I have a 90% success rate. Like I can show you, we win all the time, but we earn small amounts every time. When the buyer of the option learns larger profits from each winning trade, but doesn't win as often. So, basically what you learn from that is, should you be an option buyer or option seller? Well, it's really up to you guys. As you see, it really comes up to how you want to play. If you're interested in making big profits from one trade, then you should go for buying options. If you are satisfied with making small profits multiple times, then you can sell options. Okay. It says many option buyers aim for big profits, but end up losing the premium when their view goes wrong. So over a 6-month period, it may happen in the first 5 months that they lose the premium, get demotivated, and exit the market. However, in the 6th month, if the market moves up, they don't earn the big profits because they're already stopped out, right? So the last thing this says is, on the other hand, the option sellers get a chance to make their profits more frequently. This is because as time passes by, there's decay in the time value of the options, the theta decay, the big daddy delta, the stuff we were talking about the other day, and so the option seller can hold the position and make small profits frequently because of that time decay. Okay. So really what you really just need to be thinking about is, how have your trading gone while you were an options buyer? The average options buyer is lucky to win 10% of their trades. The average options buyer is usually bankrupt. 90% of all options buyers are bankrupt in their first year of playing options. There are huge statistics out there, or I'm sorry, there's a lot of statistics out there that show the huge differential in winning and losing when it comes to options. If you don't know what you're doing, options can be absolutely deadly. Okay. So when you start talking about selling options, we try to flip that on its head. Okay. Let's go ahead and take a look at something real quick. I want to show you guys. So think about all the times that you guys have been in on an options play. All right. How many times have you lost? How many times have you won? Now imagine, rather than pressing the buy button, what happens if you would have pressed the sell button? Every single time you would have lost would have been a win. And it's literally how it works. Okay. So I'm going to show you guys something here. Okay. So let's say you get a call here or a put here. Okay. For your option contract. And the price is currently here in the middle. The only way you can get paid on an option contract, if you buy a call side, is if the price goes up dramatically. It's the only way you make money. Okay. If the price goes sideways, you lose. If the price goes down, you lose. If the price goes up, but then comes back down, but then goes up, but then comes back down, but then goes up, and comes back down, but then eventually goes up, you can still lose because of time decay, because of the stuff we were just talking about. Okay. So in all of these situations, you lose, lose, lose. I mean, literally anything that happens, it can come up here and come back down. It can hang out here for a while. It can come down here, up here, down. Everything here you lose. Sorry, that got really messy. There we go. Okay. You lose all of that. The only time you win is when you go here. Well, now doesn't it kind of make sense why you're only getting 10% win? Doesn't it kind of make sense why you're losing most of the time? Now, for the put contract, it would be the same thing. In order to get paid, it's got to rapidly come down. Okay. If it goes here for a while, then comes down, then comes back up, it hangs out here. Anything else that it does, you lose. Okay. So as an option seller, all we're doing is flipping that on its head. Okay. Now, this is where we lose. Okay. And all of this is where we win. Okay. That's how it works. It doesn't matter what the price does in this area. It can hang out here, do. It doesn't matter. I can do this all day, guys. It doesn't matter. Okay. This is all winning trades. The only time you actually lose is if it goes parabolic one side or the other. And that's why we'll be there ready to close it. That's why we run this strategy at the end of the day and we don't watch it all day long. There's some things that I have added to kind of safeguard us a little bit from that dramatic move north or south. Okay. And we'll go through all of that here in a little bit. But can you guys see now the difference between buying and selling? Not only are you winning more consistently, you're giving yourself more optimal, more outcomes that are going to lead to profit. That's why I'm saying I'm 90% successful. Now let's talk about what they were saying earlier about. Oh no, you know what? The risk, everything else. We're going to go through all of that here in the next couple sections. Okay, so the very next section that we're going to lead into, guys, is going to be why are we going to do a credit spread as opposed to just getting into a regular sell. Why wouldn't we just do that? But before we do that, actually, let's go ahead and jump into what is a credit spread. Okay, so a credit spread is an option strategy that involves a purchase of one option and then the sale of another option in the same class and expiration, but different strike prices. I got a picture of that here for you guys. Oh, sorry. Got a picture of that here for you guys. So what this person did is they went ahead and bought here and they sold here. So just the idea of getting two different strikes will be considered a spread. And why would we want to do this is what I was just about to get into. Okay, let's go ahead and do that. Now, why would we want to even bother with that? Why wouldn't we just sell? Well, when you sell an option, what you're saying is that you're going to sell 100 shares of that option at that strike price. Okay. So if you went in here and you said, okay, well, I just want to sell one option here of SPX. Let's say I think SPX is going up, so I want to buy a put contract saying that it's. Or I'm sorry, I'm going to sell a put contract saying that it's down here and it's not going to go down there. It's going to stay either even. It's going to stay up. It's going to maybe bounce, but it's not going to go down to this level for sure, right? So I'm saying that. So when I hit review, what do you guys see here? They want $100,000 in collateral to make this trade. Now, if I win this trade, I would be winning 155 bucks, okay, or $153 minus fees, okay. So to make $153, I would be risking $100,000. That doesn't sound right, right? Okay, so yeah, let's skip that. So the reason we would do the vertical spread is because by entering them simultaneously, now our risk is defined. We're not risking 100 shares at the strike price. We're just risking the difference of the spread. Okay, simply enough. So let's see how that works. Okay, so we go and we say, okay, we wanted the 5270. We're going to sell that side. 5265. And here in a minute, I'm going to go over actually how to enter these and all that stuff. Don't worry about that. I just wanted to show you guys the difference. Okay. So now when I say that, put side. Okay. So now when I say I want to enter this position, what do they say? They say, well, just give me $5,000 collateral. Okay, well that's a lot better than $100,000. That's more manageable. And now, how do they calculate $5,000? I'll go through that here in just a second. But as you see, the $300, for a $5,000 risk is something that we can wrap our minds around. It makes a little more sense. Okay. Now, how do they find this risk? How do they determine this? Well, if you guys would see, if I go over to SPY and I do the same thing on SPY, you're going to notice something a little different. Okay, so we have the 10 contracts, right? Same thing as the SPX. We're going to go put side. Let's say we don't think it's going to get down to here, okay, and we hit review. Well, oh, sorry, we are selling. So same thing. If we review, they want $100,000 in collateral. Exact same situation. Okay. So now we go over here and we say same thing. Okay, I want the 527. We're going to buy the one underneath it. We're going to say it's a put contract, and we're going to review that. Well, now they say that they just want 800 bucks. Okay. Well, how did they determine that? Well, what's going to happen is that every strike price here that you have in between, you're saying I'm going to sell. I'm going to buy 100 shares. So in this situation, 100 shares would be a $1 strike price. So it's 100 shares times $1. On the SPX one, you'll notice there was a $5 difference. So that $5 difference was the $500 times the 10 contracts, 5,000 bucks. That's how they calculate that. Okay. So if you guys wanted to do this, you would be able to do, $100 per contract, or I guess it's coming down just a little less than that, based on the fact that we're so close to the price, or maybe they have a few other variables that they kind of, measure that a little bit, but it's usually about $100 for each contract. Okay. So in this situation, you would be risking that to make 12 bucks. You would be getting about 10% of your money in one trade in one day. Okay. We'll go over this in a lot more detail throughout the entire video, but here it gives you an idea of why we would even want to do a spread while entering a sale, because we don't want to be on the hook for 100 shares at the price that it is currently trading at. We would much rather be on the hook for the difference between what we're buying and what we're selling. And that gives us a much, much smaller risk, something that we can manage, something that we can work with. All right, so the next thing that we're going to cover is the brokers. So pretty much any broker can be used in order to do credit spreads. Not anyone, but the main major ones. However, they need to have level 3, or you need to have access to level 3 options trading. If you don't know anything about it, feel free to do some research, but it basically just outlines some of the approaches that we like to do. So I like to do straddles and the live chat that we do every single day at 3 o'clock. By the way, if you guys aren't a member of Tradecaster, it's completely free to watch me every single day at 3 live stream. I'm also doing it right here on YouTube every single day as well. So yeah, so we do the straddles, but specifically for this, we do the credit spread. Okay, so the credit spread here, credit spread here. So level 3 is going to give you access to these. If you don't have level 3, you just have to contact the broker, find out the process and the steps that you need to go through to get to get access to that. Now, I am showing you guys right now a page from Robinhood, which is going to lead me into the next point. We cannot do this on Robinhood. I repeat, you cannot do this on Robinhood, meaning that the strategy that I've used, the 90% success rate, the zero date to expiration style approach won't work on Robinhood because they have an automatic closure at 3:30 of all contracts that are open. So even if you're out of the money, even if you've already made your money for the day, they will automatically close you. They will charge you a day trade, and that automatic closure might be at a value that's not favorable, and you end up losing money on a day that you would have won, or they steal back some of your profits. So Robinhood is the absolute worst broker to do this on. The only other two brokers that I personally have tried out are Webull and TD Ameritrade. Now, Webull has better fee structure. However, there are some issues with a few other things. Like Webull, every time I contact their customer service, they're telling me, oh, it's a work in progress, or, we're still working on these things whenever I ask them about the confusing things that don't make any sense. So the only one that I have found consistency on is the one that I like to use the most, which is TD Ameritrade, which actually just got switched over to Charles Schwab. But the platform that I use is Thinkorswim, and that is exactly the same. They just migrated it over. So Thinkorswim is a great for paper trading. It's great for live trading. It will be higher fees than Webull, but the reason that I prefer it is they do not charge you more interest to go in. I'm sorry, risk, no more collateral to go in on the other side of an iron condor. So long story short, if I wanted to sell a call and a put on the same day, I would not need to double the amount of risk or the amount of collateral that I would have to use to play that play. So I can make twice as much money for the same amount of risk. And to me, that just makes sense. So yes, the fees are a little higher. The $5,000 account that we grew to 60, we gained $6,500 was still just hitting 10K because of the fees. So in $6,500 that we made, Thinkorswim took almost 20% of that. They took $1,500 of that roughly. So the fees are quite high, but it's consistent. We're making money. I guess let's just say let's give them their cut, because the more that I try to find a cheaper version, or the more that I try to find some better way as far as finances, I end up just finding a bunch of other problems when it comes to fills, when it comes to protocol, like not allowing me to use the same collateral for the other side entry. And there's also definitely been some other issues, but fills are obviously the most important thing with options. You want to be able to get in, you want to be able to get out, you want the best price. And when it comes to Robinhood, there's been a lot of issues with that too, where they'll quote you a price, but you can't get out for that price, and you always have to come down a little bit, and it always just takes a little bit of your money back. So at least with the fees, you know what you're getting into every single time. All right, now before we go any further, I want to reiterate to you guys one more time. This is one of the most risky things that you can possibly be involved in. Okay, what we have done here and have set up a very strict set of rules that are going to for the most part, eliminate the risk and allow you to trade breathing easy and not feeling that way. But if you do not stick to my rules, and if you do not listen to me, I don't want to hear any complaining, any crying, any belly aching. Oh, Scrooge, you screwed me over. No, 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 no. Okay. I will give you the formula for success, but you have to follow every single word I'm saying. So this would be the part of the video where you guys bring out a pen and a pad and you start taking notes. Because if you miss anything and you don't do even one thing right, it will absolutely result in a terrible, terrible situation for you one day. And one of the worst things that can possibly happen would be the first thing that we want to talk to you guys about, okay? Doing this, okay, is not a swing strategy. I'll say it again. This is not a swing strategy. Okay. What I mean by that is you cannot hold these overnight, guys. Okay, the only way that we trade these and the only way that you're going to trade these is with 0 date till expiration contracts. That way, at the end of the day, they expire worthless. You don't have to close them. You don't have to worry about day trade issues. And more importantly, you're out of that trade before something crazy overnight can happen while the options market is closed and you are not able to close your position. Okay, that is the worst case scenario, and that is something that we will not do. Okay, 0 date till expiration protects us. But even if you want to play different contracts and you want to test, with your test account, you want to see, different approaches to this, and feel free. But just remember, holding overnight or holding in a period where the options market is closed is suicidal at best. Okay, you are absolutely wanting to just wreck your account and not have any money left. So we do not trade like that. Okay, so 0 date till expiration is how we trade. Now there are a few options when you talk about them. We have SPY, we have SPX, we have QQQ. There was IWM. And at least a few other ones. I know that there's also some leveraged versions of these as well. However, the more I tested, the more I found that a lot of these other ones don't have the same volume. A lot of these other ones would not protect you the same way. Overall, the best absolute play that we can do with this, the way we do it, is SPX. Okay, so SPX is how we trade, and we trade at the end of the day. So when I first started this adventure, I would come in at 9 o'clock in the morning, get set up, get ready. 9:30, balls rolling. By about 10:15 to 11:15, I would be jumping in on a play and I would be holding it till the end of the day. Well, it got so tedious and I was unhappy and I wanted to find a better way. So a friend of mine suggested in a group that we're in that maybe I would try an end of the day approach. So I took what I knew, and after I think 7 months of testing, I threw it all out the window and we started fresh. And we did, and we did, started over with the end of the day strategy. So the end of the day strategy is something that's wonderful. It's working. It's amazing. And it's exactly what we're going to go over for you guys right now. Okay, so here's the setup. We're going to go ahead and get in at the end of the day. We're going to put on a 5-minute candle. 15-minute works fine too. We're just kind of getting it set up, right? We're going to look at some things. Oh, sorry, give me a second here. 15 minutes. Okay, so we're going to look at some things. We're going to look at the high of the day, and we're going to go ahead and put a mark on there. Horizontal line. Boom. All right. Now we're going to look at where it bounced off of, because at this time it was about 230. Okay. And we've seen that it had a really big bounce off of that line. Okay. So it's 330 now. Right around here, 330 is where we're going to be jumping in at the end of the day. Okay. So we got a nice idea of kind of where the price has been hanging out all day. You feel free to do some other lines if you would like. I always like support and resistance. So like right here, how it bounced off of that line and gave us a hard rejection there before blasting through. That would be a nice little support line. Or how about this? The last time that it hit this line and fell off, that would be a nice little line there. Okay. And maybe even one here. All right. So basically what we're going to do is we're going to try to get as far away as possible from this price. Okay. So what we do is, okay, so if in this situation, it would have been right here and we would have been looking like, okay, so the first thing you want to do besides getting far away is also looking at the momentum, because the momentum is what's going to knock us out of these plays. So at the last, the reason we do this at 3:30, okay, is because sometimes there's a pretty big reversal right at 3:30. So let's go ahead and go into the 5-minute candles now just to see a little bit of a difference. So you'll notice right here at 3:30, what happened? A reversal, and yeah, it did actually reverse again and continue pushing on through there. But I'm sorry, we have cats. Give me just a second. Got a little cat here on me. Okay, so it did actually push, through and come back. But did you see the 3:30 reversal that we're talking about? So we really want to just be aware of that before we jump into a play. So at 3:30, we got a pretty good idea of where the price has been hanging out all day. It's this line and this line. Okay. So at least for a while. Oh, nope, sorry. It was this line and this line. Okay, so we have an idea of where it's been hanging out. Okay, so I would feel good about getting way up here. I would feel good about getting way down here. Unfortunately, in the last 30 minutes of the day, those contracts will not have a value. So we're going to have to bring it in. And in order to bring it in and still be protected, we need to have some lines. We need to have some of these, some of these rejection lines, some of these, support lines, resistance lines, things to give us an idea of where this price might stop and bounce. Okay. So that's the first thing, because we're going to be on the outside of those lines and we're going to use those lines as stop loss tripwires and hopefully don't break through all of them and hopefully it keeps the price away from where we want. Because remember, as an option seller, we're up here. As long as it doesn't get up there, we're okay. Okay. So here, what you would see is that the price started going back down. Or yeah, the price of the SPX started going back down, but because it had been on an uptrend all day, I would have felt like, listen, I don't want to go against the trend. I would have probably gotten something down here. I would have felt pretty good about this reversal, and I would have tried to get something down here. Now, the second part of this strategy is how we enter. Okay. Now, if you entered on this streak, something down here, like we talked about in the short squeeze video, your contract is beaten down. So if you did want to get on the put side, your entry was here when the price action started pushing back that way. That would have increased the value. Now, if it kept going, you would have just waited for some sort of a reversal. And then as soon as that reversal happened, jump in because now that put has a higher value. And as a seller, we want a higher value to get in on so it can quickly reduce. Because now when the price goes back the other way, it's going to quickly reduce and go all the way back down to zero as quick as possible. We win. That's how that works. Okay. So the momentum is important. Okay. We're not going to get both sides every day. I feel like it's possible, but I also feel like I'm kind of being greedy and I don't want more losses. So to avoid more losses, to get more consistent wins, I feel like don't avoid or don't fight the trend. So when you've seen the trend was going up for the last, 2 hour, say hour at this point, because this was at 2:30, we'd be getting it at 3:30. For the last hour, the trend been going up. So yeah, there's a little bit of a reversal, but I still wouldn't have felt good getting call sides. So we can go ahead and just delete all these lines up here because on this day, oh, here, right here, on this day, I would not have entered the call side. I feel like puts would have been the way to go. And the way to enter them would have been right here when you got some sort of a swing down this way. Hopefully, you would have been able to get 52.80 or something lower because this tripwire would have been great. However, you got a great resistance consolidation area here. I would have felt really good about kind of just putting a line here. And then as long as it stays in this area, you're okay. So having multiple lines will give you multiple entries. So you're right at the end of the day. It swung down here. Let's say that 52.80 didn't ever get any value. Let's say it's still at no money at all or a nickel, which we don't play, which I'll explain here in a minute. We might have to come up a little bit. So, having a few of these lines on here, a few support and resistance lines where they bounced off of, or maybe an opening range breakout area, or maybe go back to SPY and figure out where the pre-market lows and highs were. There's lots of different lines we could throw on here to become support and resistance as the price is moving through to protect us. And that way, as long as we're on the other side of those lines, we win because those hits them, it's going to create all that support, all that bullish pressure, all that bearish pressure is going to push the price back the other way, and we stay protected and we win the trade. Okay. So basically, first step is going to be drawing levels. Second step is going to be seeing which way it's going, and we're picking the opposite direction. So if it looks like it's going this way, we're going to grab a put because the chances of it completely going the opposite direction and tanking are the lowest possible chances at that point. That gives you the highest possible chances of winning. Can it happen? Absolutely. Can it happen in the last couple seconds of the day? Absolutely. Which gets me to my next point that we want to talk about, which is our stop loss. Okay, so when we come over here and we enter or no, we can actually talk about the entry first, and then we'll go to stop loss. Okay, so the entry is going to look like this. If you wanted to get into 52.80 on the put side, at that time, okay, the first thing you're going to have to do is just make sure that it's the closest contract and it will say zero date till expiration. Make sure it doesn't say AM, which is something we'll cover a little bit later. I'll touch on that with you guys. But as long as you are clear to go ahead and, at zero date, everything's good, go ahead and set it up the way you want to. So right here we are on SPY. I did forget that. Let's go over to SPX. We're going to go back to that order that we had. Verticals. By the way, these are vertical spreads. It's how you get into them. It's another way to say credit spread or debit spread. It's a vertical spread. Okay. So on these, what you're going to always want to think about is that the sell leg of the spread is always closest to the price. Okay, so if the price is at 500 and you want to come down to 498, then the closest leg to the money is going to be your sell spot, and the one below that is the buy. But if you were going to do a call spot, the closest one to the price is your sell, and then the next one is your buy. So I'm going to do it here for you guys live. Okay, so for 5303, we go down to 5270, which is your sell. Okay. And then 5265 is the next leg down. That will be our buy. Now, the opposite side, if we were going on the high side and we were going up to 5325, let's say, then the next leg up would be 5330, and that would be the buy. So once again, the closest is the sell side, okay? But we weren't going that. We were doing a put. So we're going to go back down to the put side, and I want to show you guys how this is going to look, okay? So we do 75, and then we do 70, okay? So this gives us a price. Now, we only do 10 cents and we only do 15 cents. We do this for stop loss reasons. We don't want to have to take losses on days where we would get a bigger contract and then win on days where we'd have a smaller contract, because then that's going to mess up our overall profitability, right? So we don't take 5 cent contracts. We only take 10. We only take 15. We don't take more than that because we don't want to take a loss on a day where we took more than that. We don't take less than that because on a 5 cent contract, if you have a negative 200% or negative 300% stop loss, what that essentially means is that all it has to do is go from 5 cents to 15 cents and you lose, or from 5 cents to 20 cents and you lose. Well, these contracts jumping up to 10, 15, or 20 cents could definitely happen if the price starts going the direction you picked. But that doesn't mean that you're going to lose. So the 5 cents being stopped out is just too easy to happen. So at the 10 cents, you're not going to close it before 30 or 40 cents. That gives you a little more wiggle room. Okay. That allows you to stay in it a little bit longer, especially if it's at the last 5-10 minutes of the day and the decay is just beating it down, beating it down. The chances of it running all the way up to 30 cents or 40 cents is really, it's hard to do at the end of the day, right? So that's kind of part of this, that why this helps us out, doing it at only the end of the day. So we get in at 3:30, or sorry, we start looking at the play at 3:30. By 3:33 to 3:45, we enter our position, and this is how we would do that. So we go ahead and come over here. We say, I want this, remember, sell, buy, boom. And then you come over here and you hit review the play. And what you see is for the 15 cents that we're normally going to get, that with 10 contracts, we would be risking $5,000 to make 150 minus fees comes out to 120 bucks. Okay, so this is well, here, let's do this. Boom. Okay. So this is the least amount that you're going to make in a single day running this system. Okay. On a 15-cent day, you're going to make this much. Okay. When you get paid this credit, it is yours. When the end of the day comes and it expires worthless, you keep the credit. That's all. That's how this works. Okay. Now, if you get in on both sides and you iron condor 15 cents each, this is the most money that you're going to make in a single day with $5,000. Okay. So with this amount, you can grow, boom, 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 you grow, grow, grow. And then when the losses come, you're actually a little bit protected. And we'll talk about that here in just a second. So here you can see what the profitability is going to be, what it looks like. Okay. And then you go ahead and just enter that position. Now, when you enter the position, it'll pop up right here that you are now in this position. All you have to do from then, guys, is just watch the price. As long as the price doesn't come shooting down your direction, which in this case it did not, it turned around and shot up. you win. And you don't even really have to watch it that closely. You can just kind of check on it every, 30 seconds or so, every 45 seconds. You don't have to sit there and just stare at it. But if it all of a sudden, let's say we got a call on this one and we thought, oh, it's going to dump on down, but it swung back up here and got us. Well, that's when you have to be ready. And this is what you got to do. What you're going to do is you're going to highlight whatever play it is. If you're in both sides, you're going to have to get one side or the other, but you'll check mark the play and it'll say negative 200%, negative 300%, whatever. Okay. What you'll do is you'll press close. When you hit close, it's going to bring you into another screen. Market close. This is going to be another like key pillar here. We always market close. Okay. Most of the time you're going to get a favorable fill, more favorable than the number you're looking at the screen anyways, and it's going to instantly close your position, not allowing it to bleed any farther because of how risky this is. That is the only way that we can enter and exit the position. We limit in, we get the 10 cents, we get the 15 cents that we want, and then we market close out to get out as quick as possible to make sure that we don't lose money. Okay. We don't want them to take back what we worked so hard to gain. Day after day, we're going to keep gaining. On that one losing day that we finally have after so many wins, who cares? Just cut it. Just get out of that trade. It's not even something you really want to stay in. Okay. So for the next part, we're going to go over just a few more key things that you guys really need to focus on while doing these. And then I'm also going to go ahead and just run down some things you guys need to be afraid of or be aware of. Also, I just want to say here, and I'll say it again later, paper trade, guys. Paper trade, paper trade, paper trade. There's nothing wrong with spending a little time learning how to get in and out of these trades, learning how the whole process works. It's very, very important that you guys know how this works before you put your cash on the line, okay? Okay, before we go into the potential problems that you could run into, as well as a few other things that you guys need to know about. I did want to run this down with you guys of how this works. Okay, so when they pay you the premium, you keep that regardless. Okay, so when you lose, it just comes back off the other end. So I want to show you guys some examples here. I used to show everybody my account page and my history, but they just moved my account they just moved it to Charles Schwab from TD Ameritrade. So they actually deleted everything. So all I have is this screenshot. But what you'll see here is that even on losing days where we did actually take a loss, that we took wins on those same days. So by entering the iron, so anytime that you're going to lose on one side, you can just enter the other side. So let's say you took a call, you were wrong, it starts coming that way. Feel free to enter a put at that point, and now you're in on both sides, and that protects you. So here, and you'll see why here. So on a day that we took a loss, we also took two wins and ended up making $50. So $100, 150, and then we took the negative 200. Come over here to the next loss, which this one was $450 on the 22nd, and on that same day, the 22nd. Sorry, I have a hard time seeing this. $350 gained. So we really only lost $100. See, so you're protected quite a bit on those losing days if we just do that stop loss, 200%, 300%, whatever you're looking for, because they're going to pay you 100% on that contract that you're losing, and they're going to pay you 100% on the other side. So you already got 200%. So negative 200% means you broke even. Negative 300% means you lost one day. Negative 400% means you lost 2 days. So it's not really crazy. If it goes up negative 300%, you're going to get it right back. And I just wanted you guys to see that. And the only other thing I'm going to outline right here is how long I went without a loss. There was about a month in between all my losses. It's gain, 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 win, 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 win. Here on the next page, you'll see there were two contracts here that were not spreads. I did actually make $200 off that trade too, but other than that, I mean, very, very few wins, from 2 whatever to 318, I just didn't get one. And then from 318 to 411, I didn't get a loss. So there's just such these long streaks of wins. And then here at the end, you can see what happens when your account starts growing, because I was able to double my account within that time. Shortly after 2 months, you'll see it started 215. So at 415, I had almost doubled my account already in 2 months. So what I did is I raised up to 15 contracts. So rather than $100 at the lowest amount I'm going to make make now is 150. And rather than $300 at the highest amount now was about 500 bucks. I'm pretty sure I got in one of these. If you guys do the math. So, just wanted to show you how your losses are protected, but your gains can be very consistent and win a lot if you follow exactly what we're showing you here today. All right, so now let's go ahead and jump into the one of the big thing that you guys need to know about, and then we're going to go into some problems. So, a big part of this is that when you get in for that collateral. Okay, your collateral is now being used. Okay, you have to be able to still close that position. And the only way you can do that is by buying yourself out. If you literally use 100% of your account to enter a credit spread, you will not be able to close it. I'll say it again. If you use all of your money to enter the spread, you will have no money to close that position. So what you're going to have to do is do a little math and say, okay, well, if I like to get at 10, 15 cents, the most I'm ever going to lose on a single contract would say maybe 65 cents, $65. So you need to have $65 per contract set aside, ready to buy yourself out of that position. Worst case scenario, it jumps up to 65 cents. Okay. So important for you guys to have just a little extra money to work with. I just think it's such an important thing, and it's not something anybody's going to know about unless they trade or at least paper trade first. But if you paper trade, you might have a $100,000, $200,000 account like I got here, and then you're not going to ever know that. So very important you guys know that. So now a few more things that might trip you guys up and that are very important to note about this strategy is that something that I actually went through the other day is that there are some AM contracts once a month on the monthly expiration date, the third Friday of the month. They do an AM contract, and if you get into that AM contract, it will not close at the end of the day. It will not be expired worthless, and if there's a huge swing overnight, you could lose your whole account. So you're going to have to check as you're getting into these verticals, and just even if it says 0 day, the AM the next day is still a 0 day. This is how they got me. I was paper trading, thank goodness. But yeah, so 0 day till expiration is going to be what pops up first. And just make sure it's not the AM one. Definitely keep an eye out for that. Okay. Other things that might trip you guys up as you go along is just really not watching the contracts or not watching. You can't walk away on these guys. It could move so fast and take you out so quickly. You have to be ready. Sometimes I just sit with the market, like I'm winning the trade, and I'll still sit with the market close button, just ready to close if I need to. I'll literally come in here, I'll go market close, and I'll just be ready to close that button, because if this bid and ask could get up to that 30, 40 cents that I want to get out at, I don't want to hesitate. I don't want to be emotional about it. You're not going to think, oh, well, maybe it's going to bounce here. Nope, 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 nope. You got one loss out of 10 wins. Why would you care? Just get out of it as quick as possible, right? Okay. So you have the market closing at the end of the day that's going to give you the win. Very, very important. You guys know that. You don't have to day trade. Another potential problem is just bad fills. If the volatility is really high in the market, like we're reaching all-time highs like we have been lately, sometimes the contracts are overinflated and people don't want to purchase them at that price, or there's just a really big spread between the bid and the ask as far as the buyers and sellers, and if they're agreeing on the price and they're just not. So that's going to screw you up a little bit on getting in and out. A day like that is also going to screw you up as far as fills. You might end up getting negative 300%, and it's not really negative 300%. It's just a high volatile day. So that would kind of be a day that you might want to avoid. So sometimes the fills are going to be different between your test account and your real account, and you guys just have to be ready for that. Sometimes the fills just don't come, and you're not going to be able to play because it's the end of the day. That's something that definitely we're going to run into, because it is the end of the day. We have to find a buyer. So yeah, we're coming in for 10 cents or 15 cents. So, chances are good at least, but there might be a little bit of difference between what you experience on your test account and what you experience with your cash account based on those end of the day moves. All right, guys, that's going to be it for my credit spread video. Hopefully, at the end of this video, you guys are a little bit more understanding as to what credit spreads are, how to play them. Maybe you can start utilizing them for your own strategies. Hopefully, also, you're able to understand my process. I am going to be streaming live every single day at 3 o'clock. If you guys just want to see how these are run, if you want to see them live right here on YouTube, also over on Tradecaster, every single day live, we're going to just, run it up. I'm actually starting over a brand new account. We're going to take it for the next 3 months from 5,000 to 10,000 right in front of everybody, show them how to do it. And, we're basically going to just change trading. Okay. We don't have to have this right here, what you guys are seeing on the screen. We don't have to play like this. It's not necessary to trade hectically. We can have a plan. We can have success continuously. We can move forward with our accounts. We can trade better. Okay, guys. So I want to thank everybody for watching this video. Like, subscribe. As I said in the other video, nobody will ever see this if you guys don't help me. If you guys don't like, if you guys don't subscribe, maybe a few of you guys can even share this. The algorithm will never allow this to be seen by anybody if you guys don't, you know, do what you can do to get it out there. So we want the average trader trading better. We want the average trader making more money and being more profitable in the future. Okay, so ladies and gentlemen, I want to thank you guys very much for following me on this journey, and we'll definitely see you guys on the next one.